So guys, let me get some charts up here. Let's talk about some things that I think are extraordinarily important in today's market environment, right? Now, I want you to really take note of what I'm going to share with you today. Guys, our market, or the markets, have temporarily been hijacked. I want you to understand this very, very thoroughly. I want you to understand it clearly. Our markets have been hijacked. They've been hijacked by politics for the most part. Politics that are being driven largely by the U.S. Federal Reserve's activity of flooding this system with dollars, with money, right? And so what do I mean by the markets have been hijacked? Markets are typically driven by supply and demand channels, right? Influences of supply and demand. So more supply causes prices to come down, less supply causes prices to go up, and greater demand, and so forth and so on, right? That's normal market drivers, supply and demand. Another market driver is value versus price. So these are your financial drivers, supply and demand, relationship between supply and demand. So obviously, if there's limited supply and demand goes up, prices are driven higher. If supply becomes more plentiful and demand declines, that's what declining demand is. It's simultaneously an increase in supply. Your prices drop, right? If value versus price gets too far out of whack, then demand drops, increasing supply, and markets come down. When markets come down far enough where the price versus value is very low, so you're buying something that's worth $1 for 25 cents, then demand rises, supply shrinks, and prices go up. So these are the natural financial forces of price movement, right? There are emotional and psychological forces that move markets as well, but those are often kicked off by the financial drivers I just explained. Well, when I tell you that the market has been hijacked, it is because right now the market is not operating under the influence of its normal financial drivers. So it's not about supply and demand. It's not about value. It's just about liquidity. Do you understand? And so you need to understand this, because this is going to help you deal with this market environment better. So let me just quickly try to explain this process to you, right? Okay. I know this is going to sound like an economics course, but you have to understand the basics of this to then take this understanding into the markets and increase your odds of winning trades. So I'm going to take somewhat of a circuitous route to the final destination, which should help you trade better in this market environment. All right, so let's go. So look, the Fed, the Federal Reserve, right, largely has three tools that it can use to manipulate the economic environment, right? It has interest rates, tool one, okay? And it has monetary policy, which is money, all right? Tool number two. Now, it has a third tool, but let's just stick with these tools for the most part. These are the two major tools, okay? The third tool is it can become a buyer of assets. The Federal Reserve itself can actually start buying assets, okay? This is usually the last tool to be brought out. So I want to focus on the first tool, interest rates manipulation and monetary policy, the manipulation of the money supply in the system. So listen carefully. This is important. Interest rates have been lowered to, anybody know? More or less what? What are interest rates today, guys? I just want to make sure some people in here obviously are following things right. 0, nothing. Excellent. Good. So interest rates have been lowered to 0, which means that cash, moolah, money, earns what? Nothing. In fact, money starts to have, or cash starts to have, a negative impact if you hold it long enough, right? Because of this, tool number 2. So the Fed is pumping dollars into the system. So it's printing money. That's the common term for it. But I want you to understand, guys, this is not a printing press. There's no dollars being printed. It's just basically a computerized digit. An extra $1 trillion, boom, takes this long. Boom, now an extra $1 trillion is in the system. It's literally a computer entry. It's a digital entry for an extra $1 trillion in the market, right? So don't think that there's actual dollars being printed. It's all digital today. So cash is being increased. Think of supply and demand. So cash is being increased in an environment where cash earns nothing. So the Fed is pumping more and more cash into the system. The people who gain access to this cash do not want to hold the cash because cash earns nothing. So what do they do with the cash? They buy assets. Assets that have the potential to perform better than 0. Okay? So it goes like this. Fed brings rates to 0%. Then Fed increases money so that money then gets put into BABA, as an example. Okay? Now, to help this along, all right, this is tool number 1. This is tool number 2. And tool number 3, the Fed will pull out tool number 3 sometimes and also buy BABA. So not only is it providing the wherewithal for others to buy BABA, it can join the party and buy BABA as well. All right? Okay. You see how this works? You see how this works? You understand this so far? So because of all the money available, right? Money flooding the system, because the Fed has basically said it will support this for the foreseeable future, which means that it will continue to print more money as long as it takes. Because the Fed has said that it would buy assets itself, if need to, for the foreseeable future. Now, what is this doing? It is creating an artificial floor on all movements down. You got to understand this, traders. It is creating a floor on all movements down. So what's the moral of this story? Down equals up. I'm going to repeat it for you. Down equals up. Look, traders, look at BABA this morning. You see this? See BABA's first bar off the morning? Let me spread this out a little bit. Let me see if I can spread this out a little bit. Make it a little bigger for you. Why is that not doing it? Okay. Look. First bar off the morning. This is usually my power play. Power negative bar off the open, off the 200. This, under normal circumstances, has an 87% chance of follow through to the downside. Nope, not in the down is up market. Down equals up. Down equals up. You see, down equals up. And you've got to know this, all right? You take AMD as an example here this morning, AMD, okay? Let's go back to AMD here. This is maybe a little too big. All right, look. Down equals up. I can show it to you over and over and over again. Will you always be able to find an exception? Of course, guys. It's still real life. You'll always be able to find an exception. But for the most part, you're better off thinking down is up. You're better off thinking down is up. Do you understand? You're better off thinking down is up. Okay, now how far up, that's a different story. But it is better to be a down is up trader than a let me find the short opportunity trader today. And I think that this is going to go on for a while. Do you understand? So here's my point. If you're having trouble in this market, which has actually become an easy market to make money in because of what I'm explaining to you, if you're having trouble, I guarantee you the percentage of times you go short is too high. That's the problem. There could be other problems, but that's probably at the heart of your issue. You're in a down is up market environment, but you're still trying to play the side that has the lowest odds, the short side. Do you understand? That's what you're trying to do. It's the only way to have a hard time in this market where down is up. Now, why am I saying that this is an easy market? Because the down is up market that we're in now is what I refer to as the idiot market. Now, I mean that with all due respect. What's the idiot market? Most untrained market participants will make money in a market like this because the general consensus on the part of untrained people is down is up. Okay, so what I mean is that they don't look to the left. They haven't been trained to look to the left. So let me give you an example of this. Let me see if I can give you an example of this. Okay. You would normally, with my teaching, not want to buy above this green bar right there. Boom. Why? Why, with my teaching, is that normally not a good buy? Why? Tell me. Someone tell me. Why is buying right there, right? You got the 200 overhead and you got power to the downside, right? That's right. So guys, listen to me carefully. When you are in a down is up market environment, what is to the left no longer matters. Look at this. What is to the left, the red, no longer matters. Let's cross that out. And what is above doesn't matter, the 200. Let's cross that out. Listen to me carefully. What is to the left of your buy signal no longer matters. And what is above your buy signal no longer matters. It's almost as if the buy bar is the first bar of the stock's life in a down is up market. There's no history to the left. There's no history to create something above. It's the IPO bar. It's the first bar of the stock's life. Now, watch what happens when you take that view. Let's go over a few things. So what I'm going to do is I'm going to erase what is to the left. Try to get this right. All right. Let me do it. Big strokes here. Easier. All right. So we're going to erase what is to the left. We are going to erase what is above. Now, go. Where's your buy? Above the green. Boom. Where's your stop? Below the green. Enter. There's nothing to the left bothering you, and there's nothing above bothering you. I know this flies in the face of what I've been teaching you for a long time, but when in Rome, you have to become a Roman. And so we're in Rome right now. All right? This is just the way it is. Is it going to stay this way? No. But right now, just waiting for a buy signal works. Let me show you. Let's take a look at Roku today. All right. Now look. Here's the buy bar. All right. You should want to buy into this or even above it. All right. So look. Okay. Now look. Do your odds, you see this is starting to look toppy? No. Wait for the next buy signal. You missed this, or you're already taking profits, but you want to get back in, you're going to wait for the buy signal. You're going to ignore the sell signal. Boom. There's your next buy. Take out this singular red or this bar. Okay? You're going to wait for the buy signal. You see that topping tail bar right there? Some people would be really tempted to short that. No. Even if it comes down, miss that opportunity. Just wait for the next. What's the next buy signal? You know what a buy signal is. See that topping tail bar there? No. No. Not in today's market. Forget that. Wait for the buy. Look at this. You see that? It's crazy. I know. This is the buy. Now ignore what's to the left and ignore anything above it. It's crazy. I know. All right, here's your next buy. Green takes out red. Don't go for this short. I did that this morning. I made $3,000, but that's not you. I don't want you doing it. All right? But if I didn't get out of this real fast, look at what would have happened to me. I would have gotten slammed. All right? Wait for the buy. Here's the buy. Here's the buy. Here's the buy. Stop trying to be cute and pick the top. Will you miss some opportunities? Yes, so what?